When we are talking about equity, we have share capital, share premium, retained earnings, and other components of equity. And each of these lines has its own meaning. So with a question, when we have an instrument and we need to recognize it in some way, first of all, we check whether it's a financial liability or equity. In the example that was tested, it was share-based payment. So this is IFRS 2, it is more important than IFRS 9 and IAS 32 in this very matter. If it would not be share-based payment, we would apply IAS 32. In this case, the settlement is going to be with company's own shares. So this means that we need to do something with equity, not with liability, and we need to clearly state it. As for equity, share capital is needed in order to be able to calculate the number of shareholders at any point of time. So we can record something there only when we already have those shareholders that can claim dividend, that can vote, and so on. If these are just future shareholders, share capital is not the account. Share capital is recognized only in nominal value, so that at any point of time you can take the amount, divide it by the nominal value, and get the number of shares in issue. And share premium is the balancing figure in your transaction. Like, for example, if you're going to sell your shares, it's going to be debit cash, credit share capital in the nominal amount, and then credit share capital for the rest. Retained earnings is needed to accumulate profit. There are also going to be some adjustments that are going to touch it, but still, this is to accumulate whatever is the profit. And other components of equity is for the rest. And as for the share options, since we have just promised them, we keep them in other components of equity. And that's how it works.